Every day, about $200 trillion moves through the global banking system. Not billion, not trillion per year, 200 trillion every single day. That's more money moving around daily than the entire planet produces in 2 years. But here's the strange part, most of that money doesn't pass through the banks you know. Not JP Morgan Chase, not HSBC, not even the Federal Reserve. Instead, it moves through a hidden hierarchy of institutions most people have never even heard of. Because the banking world isn't flat, it's a pyramid. At the bottom are the banks you and I use. Above them are institutions that control the flow of capital across entire economies. And at the very top, organizations that quietly shape how money itself works. So let's climb the pyramid. Now, at the bottom of the pyramid are the banks you and I actually deal with. Your checking account, your mortgage, your credit card. These are commercial banks. And here's something that should probably be taught in school, but usually isn't. Banks don't lend out deposits. That's the myth. What they actually do is create money when they issue loans. Imagine you walk into a bank and ask for a $100,000 mortgage. The bank doesn't walk to a vault. It doesn't check if another customer deposited that money. Instead, it simply creates a new entry in your account. Your balance suddenly shows $100,000. Before that moment, the money didn't exist. Now it does. This process, banks creating money through loans, is responsible for about 90% of the money circulating in modern economies, which means commercial banks aren't just financial middlemen, they are money factories, and where they choose to direct that money shapes the entire economy. If banks pour credit into real estate, housing prices explode. If they lend heavily to business and manufacturing, factories get built and industries grow. Central banks, like the Federal Reserve, set the interest rate, but commercial banks decide where the money actually flows, how they make money. The core business is simple: interest spreads. Banks pay depositors a small interest rate, then they lend that money at a much higher rate. If your savings account earns 2% and your mortgage costs 6%, that 4% difference, multiplied across millions of loans, becomes enormous profit. But interest isn't the only source. Banks also earn money from account and transaction fees, credit card fees, late payment penalties, trading in currencies, bonds, and derivatives, interest from holding government bonds. The biggest banks are massive financial machines. In 2023, JP Morgan Chase made $49 billion in profit. That's more than the entire annual economic output of some countries. And remember, these are the bottom layer of the global banking pyramid, which raises a question. If these giants are only tier 4, who sits above them? Now we move one level higher in the pyramid. To understand this layer, we have to go back to 1944. World War II is almost over. The Allied powers know the global economy will need to be rebuilt from the ground up. So representatives from 44 countries gather at a hotel in Bretton Woods, New Hampshire. Their goal is simple: design the post-war financial system, and at the center of that system sits the United States. Out of that conference came 2 institutions that would shape the global economy for the next 80 years. The International Monetary Fund, the World Bank. People often confuse them, but their roles are very different. Think of the World Bank as the builder, and the IMF as the firefighter. The builder, the World Bank. The World Bank lends money to developing countries to build infrastructure. Roads in India, hydroelectric dams in Ethiopia, water systems in rural Africa, schools in Kenya. The idea is straightforward. Build infrastructure leads to increased productivity, leads to grow the economy. These loans are long-term, often 10 to 40 years, and usually come with relatively low interest rates. The firefighter, the IMF. The International Monetary Fund operates in a very different situation. The IMF shows up when a country is in serious financial trouble. Maybe the government borrowed too much. Maybe the currency is collapsing. Maybe foreign reserves are running out and the country can no longer pay for imports like food or fuel. That's when the IMF steps in with emergency loans. But the money comes with conditions. Governments may be required too. Privatize state-owned industries, cut government spending, remove subsidies, raise taxes, open markets to foreign investment, balance national budgets. This package of reforms became known as the Washington Consensus. And in the 1980s and 1990s, dozens of countries went through IMF programs. Argentina, Mexico, Thailand, Indonesia. Take Indonesia in 1997 during the Asian financial crisis. The currency collapses, inflation surges, banks fail, foreign investors flee. The country is running out of dollars to pay for imports. The IMF arrives with a rescue package worth about $43 billion. But the conditions are harsh. Interest rates rise sharply. Government spending is cut. Insolvent banks are shut down. The economy is rapidly restructured. The result? Unemployment triples. Poverty doubles. Riots break out. And eventually the longtime president Suharto resigns after more than 3 decades in power. The economy did recover in the years that followed, but the human cost was enormous. Supporters argue the reforms laid the groundwork for Indonesia's later growth. Critics argue the IMF made a bad crisis dramatically worse. Both sides have evidence. Why countries still accept IMF deals. Because the alternative is often financial isolation. If a country falls behind on its obligations to the IMF, the consequences spread quickly. International lenders pull back, bond markets close, foreign investment disappears. Countries like Zimbabwe, Sudan, and Somalia have experienced this kind of isolation. The IMF doesn't need an army. It doesn't threaten invasion. It simply closes the financial door. Who controls these institutions? Both the IMF and the World Bank are funded by member countries. Each country contributes capital, and voting power is largely based on how much money you put in. The largest shareholder in both institutions is the United States. And since the end of World War II, an unwritten rule has held. The president of the World Bank is always American. The managing director of the International Monetary Fund is always European. That arrangement has remained in place since 1945. The pyramid reminder commercial banks create money, but institutions like the IMF and World Bank shape how entire countries interact with the global financial system. And yet, even they are not at the top of the pyramid. There is another layer above them, one that quietly coordinates the world's central banks themselves. Now we move higher in the pyramid. These are institutions most people have heard of, but few could actually explain. The Federal Reserve, the European Central Bank, the Bank of England. Central banks are not normal banks. They don't want your deposits. They don't give you a mortgage. You can't open an account there. Their customers are commercial banks. Every commercial bank, whether it's JP Morgan Chase, Barclays, or your local credit union, holds an account at the central bank. These are called reserve accounts. Think of them as the banking system's master ledger. When you send money to someone at another bank, something interesting happens behind the scenes. Your bank's reserve account shrinks. Their bank's reserve account grows. No cash moves, no armored trucks, just numbers shifting on the central bank's balance sheet. This is how most payments in modern economies actually settle. But the real power of a central bank lies in something deceptively simple: one number. The interest rate at which banks lend to each other overnight, often called the interbank rate. When a central bank adjusts this rate, the effect ripples through the entire financial system. Mortgage rates change, credit card rates move, government bond yields shift, business loans become cheaper or more expensive. In other words, one decision by a central bank can influence millions of financial decisions across an entire economy. Lower rates make borrowing cheap. People buy houses, companies invest, spending rises, but too much borrowing can overheat the economy and trigger inflation. Higher rates do the opposite. Borrowing slows, inflation cools, but pushed too far and economic growth can stall. It's a delicate balancing act, like trying to control a massive economy with a single dial. Central banks also possess one of the most unusual powers in modern finance. They can create money. When the Federal Reserve buys government bonds from a commercial bank, it doesn't pull money from some vault. It simply credits the bank's reserve account. Numbers appear. New money enters the system. No printing press required. The official term for this process is quantitative easing. In plain language, it's money creation with a keyboard. After the global financial crisis and the pandemic, central banks created trillions of dollars this way. Do central banks make profit? Yes, but profit isn't their goal. Central banks typically earn money by holding government bonds, which pay interest. They also earn income from seigniorage, the profit that comes from issuing physical currency. But central banks don't keep the money. Most of their profits are transferred back to the national treasury. The mission of institutions like the Federal Reserve or the Bank of England isn't profit. It's economic stability, keeping inflation under control, maintaining confidence in the currency, and preventing financial crises from spiraling out of control. Commercial banks create most of the money. Central banks control the rules of the system those banks operate in. But even central banks are not completely independent. Above them sits a quieter institution, one that coordinates central banks themselves. An institution sometimes described as the central bank of central banks. And that's where the pyramid reaches its peak. It turns out, the most powerful financial institution in the world doesn't have a single customer, no ATMs, no savings accounts, no app. It's called the Bank for International Settlements, the BIS, and it was born in 1930 out of one of the most awkward post-war situations in history. Germany owed war reparations after World War I. The Allies needed a neutral place to collect the money without it getting political, so they created a bank, owned by central banks, to handle it. The reparation situation eventually collapsed. The BIS survived, and over the next century, it quietly became something far more interesting, the place where the world's central bankers meet in secret, set the rules for global banking, and coordinate policy. Here's what the BIS actually does. It hosts monthly meetings in Basel, Switzerland, where governors of major central banks sit in a room and talk about the global financial system. The Fed, the ECB, the Bank of England, the Bank of Japan, all of them. No press, no minutes published, just a dinner, some conversations, and possibly the future of your mortgage rate. It also sets the Basel Accords, the global rule book for how much capital banks must hold. Every commercial bank in every country that adopted Basel III is essentially following rules written in that building in Switzerland. And if you want to fund all this, the BIS is owned by 63 central banks who contribute capital and receive interest. It makes money like a regular bank, lending, investing, but its job is coordination, not profit. Most powerful, least known. Commercial banks are where ordinary people go. Investment banks are where corporations and governments go. Think firms like Goldman Sachs, Morgan Stanley, and the historic banking house Rothschild & Co. These institutions operate in a completely different world from your local bank branch. They don't take deposits from the public. They don't offer checking accounts. You can't walk in and ask them for a mortgage. Their clients are governments, billion-dollar corporations, and institutional investors. Their main job is helping large organizations raise enormous amounts of capital. They do this by structuring and selling financial securities. For example, initial public offerings, IPOs, taking a company public on the stock market, bond issuances, helping governments and corporations borrow from investors, debt restructuring, reorganizing companies drowning in loans, capital raising, connecting investors with firms that need funding. Investment banks also advise on mergers and acquisitions. When one giant company wants to buy another, the negotiations are rarely handled alone. Advisors from firms like Goldman Sachs or Morgan Stanley step in to structure the deal, value the companies, negotiate terms, and manage the financing. And the deals can be enormous. The fees are enormous too. Take the IPO of Saudi Aramco in 2019. It raised $25.6 billion, making it the largest public offering in history. The investment banks advising on the deal collectively earned about $90 million in fees for a few months of work, and that's just one transaction. Large banks may advise on hundreds of deals per year. Many investment banks also operate massive trading divisions. They buy and sell stocks, bonds, currencies, commodities, derivatives, sometimes on behalf of clients, sometimes for their own profit. These trading desks can move billions of dollars in minutes. The real product, access. At the end of the day, the investment banking business model is surprisingly simple. They sell expertise, connections, and access. Access to investors, access to capital markets, access to the rooms where billion-dollar decisions are made. If a government wants to borrow billions, or a tech company wants to go public, or two multinational corporations want to merge, investment banks are the ones structuring the deal behind the scenes, and they charge extraordinary fees for making it happen. Here's where things start to get strange, because alongside the traditional banking system, there's an entire parallel financial system. It looks like banking, it acts like banking, but technically, it isn't made of banks. This is known as the shadow banking system. It includes institutions like money market funds, hedge funds, private equity firms. They take in huge amounts of capital from investors, then they lend that money out, invest it, or use it to buy financial assets, earning a profit from the difference. In other words, they perform many of the same functions as banks, but with one critical difference. They operate outside many of the regulations applied to traditional banks. They don't face the same capital requirements. They don't maintain reserve accounts at central banks like the Federal Reserve, and they often sit in the gaps of financial regulation. One of the earliest examples was the rise of money market funds in the 1970s. At the time, regulations limited how much interest commercial banks could pay on savings accounts. Investors wanted better returns, so financial firms created funds that invested in short-term government debt and corporate paper. These funds offered higher yields than bank accounts, and they allowed investors to withdraw money almost like cash. To many people, they looked just as safe as a bank account, but technically, they weren't. That illusion shattered during the global financial crisis. One of the largest money market funds at the time, the Reserve Primary Fund, suffered heavy losses after holding debt issued by the collapsing investment bank Lehman Brothers. The fund's value dropped below $1 per share. In the money market industry, that's called breaking the buck, and it triggered panic. Investors suddenly realized their cash-like investments might not actually be safe. Within 48 hours, about $300 billion was withdrawn from money market funds. The short-term funding markets that large corporations rely on began to freeze. The entire financial plumbing of the economy was close to seizing up, so the Federal Reserve stepped in. It created emergency facilities and effectively guaranteed large parts of the money market industry, which leads to the strange paradox at the heart of shadow banking. These institutions exist partly to avoid banking regulations, but when things go wrong, they still need central banks to rescue the system. Shadow banking works beautifully when markets are calm, but during a crisis, it often turns out to be less stable than the traditional banking system it tried to bypass. So here's the pyramid. At the very top, the BIS, setting the rules for central banks, invisible to the public. Just below, central banks, creating money, setting rates, regulating the whole system. Below that, the IMF and World Bank, managing crises and development on a global scale with enormous political strings attached. Below that, commercial and investment banks, making loans, creating money, advising deals, taking fees, and woven through everything, the shadow banking system, acting like banks, regulated less like banks. Every single dollar you spend, save, or borrow passes through this structure. Every interest rate you pay was set somewhere in this chain, and the next time someone says the government controls the money supply, well, maybe you've got a more interesting answer now.